Hello out there. Once again, this is Latoya Tillett, owner of Tax Plus Financial Services, coming to you again with another midweek tax help. So just wanted to come to you guys today to give you an overview of the updates for the 2020 slash 2021 tax filing season. We had a lot of changes last year, a lot of different things going on with the whole pandemic and everything. So there definitely are a few changes that have happened for this year. So I just want to kind of explain those to you. Give you a brief overview of what it is, and don't want to take up too much of your time. And I thank you all for watching. So let's go ahead and get right to it. So just so you remember, your taxes are still due April 15th, 2021. And if you have a corporation, partnership, corporations, C corporations are due still on April 15th as well. But your S Corps and your partnerships, LLCs, those are all due March 15th. And if you have a nonprofit, your tax returns are due on May 15th of this year. The IRS has announced that they will not start accepting or processing tax returns for this tax season until February 12th. So just so you guys are aware of that. So a little bit that has changed so far for this upcoming tax season is the income tax brackets have been increased a little bit to account for inflation. So there you have it there. So you have a little bit of an increase on the income tax brackets. Another thing that has also increased are the standard deductions. So if you're single, last year for 2019, it was $12,200, and for 2020, it'll be $12,400. So it went up about $200. Married filing joint went up about $400 to $24,800. Married filing separate also went up to $12,400, which is a $200 increase. And head of household went up to $18,350, which is a $300 increase on your standard deductions. Now, to decide if you need to do a standard deduction or itemize, it's usually best if you, let's see, what's the easy way to put it? If you kind of calculate what your itemized deductions will be. If they do not equal more than the standard deduction, then more than likely it won't be very helpful for you to file itemized on your tax return, unless there's some reason your situation that you have to file itemized. I know normally if it's a married filing separate situation, usually if the spouse itemizes, you have to itemize as well. But for the most part, if your itemized deductions aren't going to equal more than your standard deduction, it's best to just go ahead and take the standard deduction. Let's see, what else do we have here? Of course, it could be a little bit more of a hassle to itemize your deductions, but again, if it exceeds that amount, it's definitely worth the time taken to do so. Some of the things you can itemize on your deductions will be like, your mortgage insurance you pay for your home, your property taxes, medical bills that you paid outside of your your plans, or anything that you had to pay out of pocket, as long as it's more than 7.5% of your adjusted gross income. Anything above that can be added to your standard deductions. So, of course, everyone's situation is different, so you definitely want to consult a tax professional if you have one. If you don't, we are available and we are open, and we are taking new clients at Tax Plus. So just feel free to reach out to us and let us know. There's also some software out there. If you do your own taxes, there's some software that'll let you go ahead and put in your itemized deductions, and it'll compare it for you. And it'll say, oh, okay, well, your itemized deductions are X amount of dollars. So we feel it's best that you go with the standard deduction. So you will see that on some softwares that you may use, probably like TurboTax and some of the other ones out there that consumers use to do their own taxes. Let's see what else we have. So another interesting update to the 2020 taxes is charitable deductions. Due to the CARES Act, it now allows you to deduct up to $100,000 of your adjusted gross income. So that's your total income minus any other deductions that you've already taken. And so, and you could do that for qualified charitable donations if you plan to itemize your deductions. So usually you can only take the charitable contribution deduction if you're itemizing your other deductions. But they're also, if you're not itemizing your deductions, you're taking the standard, the CARES Act also added a new above the line deduction that will let you write off up to $300 of charitable contributions that you made in cash. So charitable contributions would be, if you sponsor, sponsor something for a kid's school, you do some type of sponsorship to any nonprofit organization, you have to have a receipt, of course. If you pay tithes and offerings to your church, you'll usually get a statement from them as well. So these are some new deductions that you're able to do. Usually the charitable deductions are only worth 50% of the amount that you deducted. But now with the CARES Act, you can deduct up to 100% of it. So that's a good thing. Of course, medical deductions, I touched on that a little bit. That's above the 7.5% of your adjusted gross income. Of course, business deductions, I will have more videos coming on which items can be deducted for your business. So stay tuned for those. I won't go into too much detail right now because I'll go into more detail when I do those videos regarding your business deductions. So I will be doing videos coming up regarding your anything that you can deduct for your self-employed business or your LLCs or corporations. The earned income tax credit. The earned income tax credit is a credit that the government pretty much gives you to say, thank you for working. Here you go. So it's just, a little credit. That's a refundable credit that comes to you on your tax return. If you owe taxes, it will reduce the amount of taxes that you owe. If you're getting a refund, it could increase your refund. So right now, workers earning up to $56,844 during the 2020 tax year may be eligible for earned income tax credit. The child tax credit, that's another increase. So if you have children, you can claim up to $2,000 per qualified child. There are income limits, of course, which are $200,000 for single parents and $400,000 for married filing joint. So this is actually a refundable credit. So just for example, your family could receive up to $1,400 per child as a refund. Okay. So now the coronavirus and your taxes. This is the thing that everybody's been asking me. This is what everybody's been wanting to know. Like, we got unemployment, we had PPP loans, we had EIDLs, we had a lot of things going on. We had grants. It was just a lot going on due to this pandemic and the CARES Act and different things they were trying to do to help stimulate the economy, and to, keep our small businesses open and keep our workers working. So some of the things that you may not know, we all pretty much, most of us who qualified, received a stimulus payment last year. What we didn't know and what wasn't fully explained to us is that it won't count as taxable income, which is what they did tell us that part. It's not going to count against you as taxable income. You don't have to file it. Okay, but what they didn't tell us, or maybe what wasn't clear to a lot of people, is that instead of being treated like a refundable tax credit for 2020, your stimulus payment is being treated like a refundable tax credit for 2020. So it's kind of like they gave you an advance on the refund you would have gotten. So if you were going to get a $6,000 tax return, they're going to deduct that $1,200 or whatever they sent you. They're going to deduct that from your tax return. So yeah, pretty much it's like an advance on the money that you would have received as part of your tax refund this year. So I know that's not going to make a lot of people too happy, especially because we're still in the midst of this pandemic. And, we just really need all the help we can get right now. So if you were looking forward to a refund, your stimulus payment was actually an advance on that refund. If you received a PPP loan, that's the Paycheck Protection Loan for the small business owners and self-employed people out there that applied and received those. You don't have to file on your PPP loan, and then some of those loans are able to be forgiven as long as you used it for what you said you were going to use it for, which is your business expenses like payroll, rent, or interest on your mortgage payments and utilities. And but with that, if you use the PPP loan to pay those things, you cannot write off any expenses that you paid with the money from the PPP. Okay, again, let me read it exactly how it says. The IRS says that any expenses you paid money from those PPP loans cannot be deducted from your taxable income. So only anything above and beyond what you paid outside of the PPP loan. But if you directly use monies from your PPP loan to pay any of your business expenses, you cannot turn around and write those expenses off again on your tax return. So I want you to be well aware of that. I did a video on the unemployment benefits. Of course, a lot of us were receiving unemployment, and they were giving out the extra $600 per week. And like I was telling you guys, unemployment is considered taxable income when it comes to your taxes. So if you neglected to have income taxes withheld from your unemployment, you will potentially end up owing some money on your tax returns. So for more details on how unemployment works, please watch my live video that I did. It was last week, I think. Darn, I can't remember the date. What was the date? 13th? No. I think maybe it was the 13th or something like that, or maybe it was the week before. Just check out my page, Tax Plus Financial Services, and look for that live video. It's labeled unemployment and how it affects your tax return. Okay. Or you can also, if you can't find a video or don't want to look for it, feel free to ask me. I can direct you to the video or send you the link to it, or you can read IRS Publication 525, page 27, as it relates to unemployment benefits. Educational expenses, that's another update that they've made. So that's your 529 plans and your ESAs. So any money you take out of a 529 plan or educational savings account, that's the ESA, it must be used for qualified educational expenses in order to be tax-free. But with a lot of schools going remote and pushing to distance learning, that means some of the money may have been refunded to you. If you did get a refund, I just want you to know you had 60 days to put that money back into the account or to cover additional educational expenses. If you didn't, you may have to pay taxes and a withdrawal penalty on those funds if you did not put them back into your account within the 60 days. And so another thing that you can use it for, another couple ways that you can kind of get around paying the taxes on that is you can use the 529 plan to pay for costs of certain apprenticeships programs. So that's including fees, books, and supplies. Another way you can kind of get around that is you can use the money from the plan to pay off up to $10,000 in student loan debt. That's $10,000 total, not annually. That's total. Okay, just want you guys to be aware. Another update is to your retirement plans. A lot of people who have W-2 or are W-2 wage earners, or, even self-employed people, there's retirement plans out there like your 401ks, your IRAs. So the CARES Act now allows people under 49 and a half to take up to $100,000 out of their 401ks and IRAs until the end of 2020 without having to pay an early withdrawal penalty. So that's a good thing if you had to do that, or you were put into a position where you had to withdraw some funds for your 401k or your IRA. So just keep, a lookout for that. Of course, always consult with your financial advisor as to how that works, okay? Sorry, I'm trying to fix my shirt. All right, so what else we have? Second, the money that you take out is tax deferred. So from your retirement accounts, like traditional 401ks or IRAs, it will be taxed as ordinary income. So you may possibly, well, more than likely, if it's going to be taxed, you're going to have to pay some taxes on your withdrawals you make, okay? If you own an IRA and you have to take money out of your account, once you used to have to take money out of your account by a certain age, and that's called a required minimum distribution, or RMD. The good news is the CARES Act allows seniors to skip RMDs altogether. Usually you would have to take the money out by the time you're age 70 and a half. They've pushed it back to now 72. And it looks like we just lost power again due to the high winds. I figured that was going to happen, but I'm going to just keep going with my video. So where was I? Let me get back to my notes. Okay, CARES Act allows seniors to skip the RMDs altogether in 2020 without a penalty. Okay, so this could definitely lead to significant tax savings for retirees whose accounts, since the money that was taken out of the traditional IRA account, IRAs counts as taxable income. Sorry, just getting kind of distracted here because I can't believe the power went out again. You may have heard the wind in the background a little bit. The winds have been really high out here in the Inland Empire. So yesterday we lost power for a few hours and we just lost power right now. So bear with me. Okay, so the Secure Act also allows owners of traditional IRAs to keep putting money in their accounts past age 70 and a half, starting in 2020. Okay, so one last note. You have 3 years to put funds back and get a refund on any taxes you paid on the money that you withdrew from your 401k or traditional IRA. And also, it's probably a good idea to reach out to your investment professional or your financial planner or advisor and have them walk you through the process of how you can do this to avoid any large tax penalties. So that's all I have for the current tax updates for 2020. Check me out next week. Make sure you come here and visit the page. I'll be doing a video on, let me see. I'll have another video coming to you next week. That'll be some helpful hints, helpful tips for you to make sure you can help you navigate through this year's tax season, as we had a lot of challenges last year with the current pandemic, and we're still actually facing a lot of those same challenges. So I want you to be prepared for what's to come from last year, as well as be prepared going forward with 2021 as it relates to your taxes and your businesses, your small businesses, and helping you just be prepared and stay organized and just keep track of everything. You know, since you have the time on your hands, take the time to really look through all of your expenses, keep all of your receipts, keep everything organized, so then that way, you know, you can hand that over to your tax preparer, or you can prepare your taxes yourself accurately. Once again, I'm Latoya Tillett, owner of Tax Plus Financial Services. I look forward to seeing you all again next week for midweek tax help. And feel free to follow my page. It's Tax Plus Financial Services, and that's on Facebook. On Instagram, it's also Tax Plus Financial Services. My phone number is 909-494-2280. You can visit my website. That's taxplus-financialservices.com. Visit the website and book your free 15-minute consultation so we can go ahead and get you prepared. If you're in the market for a new tax preparer, please feel free to reach out to us. Like I said, we're open. My team is ready to get to work for you. And we are remote, and we work remotely, and we have been since we started the business. So it's not new to us to be virtual. So yeah, if you're looking for a good, honest tax preparer that can help you navigate your financial crisis, because most of my clients end up coming to me, they have a financial crisis. If you're looking for somebody to help you through that, I am definitely your girl. My team and we work hand in hand with all of our clients to make sure we get them out of any tax jams they may have gone into, and then we get them cleaned up and get them straightened out going forward. So look forward to speaking to you all again. I will see you all next week on next week's midweek tax help. Look forward to talking to you. Have a good one. Stay safe out there. Please, please stay safe out there. I know a lot of people, the cases are rising for coronavirus, so please stay safe. Talk to you soon.